Well, good afternoon, everybody. This is Tom Byrne from Wealth Strategies and Management. Let's see if we can get our disclaimers read here so we don't get in trouble with compliance. And we just have a little computer issue here. Here we go. Investment advice is offered through a private advisor group, a registered investment advisor. WSNM LLC and PAG are separate entities, as is Bond Squad from PAG. The opinions voiced in this material are for the general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and is no guarantee of future results. Someone please tell that to the MPT folks. Another interesting day in the market. We started up over 100 points, ended down over 200 points. We had a little euphoria from stimulus comments made by the Chinese and Japanese governments respectively. At least the Japanese are talking about a corporate tax cut. It'd be nice if they would reduce the roadblocks to starting new businesses in Japan, and try to boost that consumer sector up through entrepreneurism. Because right now, with the declining population, Japan is not structurally capable of consistent, even what we would consider trend growth. China's China. It is trying to morph from let me fix the camera here, morph from a export-driven economy to a manufacturing-driven economy to a somewhat consumer-driven economy with the heavy hand of the government on top of it. Now, this morning on CNBC, Jim Chanos from Kinnikos Associates, who's been a longtime China critic, maybe even a China bear, he does run a short selling hedge fund, pointed out that China's GDP has been slowing about 2% a year. That means the growth rate has been slowing. It's still expanding, but at a 2% slower pace each year. On top of that, about 50% of China GDP is due to government investing, which means that the government orders businesses to produce widgets, even if the widgets are not needed. And on top of that, it props up zombie companies with zombie loans and zombie bonds and zombie securities of all kinds. So he also points out, and this is correct, that China has done nothing really materially to reform its economy, to bring it towards the modern free market world. It talks a good game, but that's it. So China eventually is going to have to fish or cut bait. It's either going to have to be all of one, all the other. It reminds me of Abraham Lincoln made that same comment about slavery. He said, house divided against itself cannot stand. He said he could see the United States being either all slave or all free. The combination of his is difficult, but he said he'd take anything just to keep the union together. China has to decide what's more important, a tight grip on the economy or economic vibrancy. And it wants to have its cake and eat it too. And I don't think that is possible at this point, but we'll see how it plays out. Meanwhile, the markets are afraid that China is going to drag the global economy into recession. Don't think so. Could it shave some off of some growth? Yeah, it could. Globally, maybe it shifts a half a point to a point off of growth. Maybe in the U.S. it takes a quarter to a half a point off of growth. I don't think it's even that much. But the problem isn't with China's growth; it's with the market's perception. We said this before. I said it before on this broadcast that the markets were priced for the U.S. eventually blowing past 3% growth and probably getting above trend for a while, and inflation going back up above 2%, and China growing at least in the high single digits for another decade or so. Neither one it looks to be in the cards for the foreseeable future. So what happens? The markets have to reprice. This means a lot of the growth expectations have to be reined in. PE expansion has to be reined in. The possibility of dividend increases and share buybacks have to be reined in, and we reset the market. And we see this today. And it seems like every time the market, the equity market gets to a certain point, it's trading in a very narrow range here. It sells off. When it gets down too low, it rallies back. That's probably algorithms in there, but there's no compelling reason to go overweight for the equities for the purpose of short-term gains. Long-term gains, growth over time, good dividends. Yes, there's good there's good opportunities out there for certain investors for, if you're suitable, for that type of strategy. But it's not that slam dunk, just throw a dart at a board and whatever you buy is going to make money. Now we all have to do our homework. So that's where we stand with the markets today. We saw the 10-year Treasury note yield bounce up to about 224 at one point today before settling back down. What was interesting was that when the 10-year broke above 220, the punditry was out to say, oh, here we go, rates are going to go higher now. We could see 240, 250, 260 by the end of the year. And I have this bridge in Brooklyn that I'd like to sell you, but no, it's really not that bad. But 250 is probably the upper range of what we might see if the cards, are played right and the chips fall just right. But that's still, not a foregone conclusion. We have inflation still running, measured by core PCE, the Fed's favorite measure at 1.6%. That's not conducive of higher long-term rates. And again, we have this misconception that the long end predicts growth. The long end of the curve predicts inflation, not growth. Most of the time, growth and inflation move in the same direction. This is not always the case. It didn't happen in the late 70s, early 80s. It didn't really happen in the 30 years that followed. We had inflation pressures lower on average each expansion cycle, but growth was pretty good, right? So they're disconnecting there. We're seeing a disconnect between hiring and wages. Bloomberg had an article out today highlighting a Fed study, a Fed paper that was written back in June, which states that there are reasons why the NAIRU, the full employment rate, might be lower than the Fed's low 5% area. It's funny because I wrote that back. I think it was February. I made that exact argument. I was hinting at it all last year that NAIRU might be lower than we think, and this begs two questions: is NAIRU lower, like I wrote, 4.5 to 4 3/4 unemployment, the headline rate? And how real that is also depends on how you view the labor force. Excuse me. But there's also the possibility that we really are at NAIRU. The Fed is right, and this is close to full employment, and these are the wage pressures we're going to see. So that's very possible. So that means there's probably not a whole lot of inflation coming down the pike. You have disinflation, if not deflation, being exported from overseas. You have very little upward price pressures here, and as I said before, there are two main ways to get inflation. You have too much money chasing too few goods. That's a money supply issue, right? You have a lot of money in the system, and that is also a devaluation problem. But it starts to chase too few goods and opportunities, pushes those prices up, and you have inflation. The other is a currency phenomenon as well, where you just print dollars, and it's worth less in the open market versus other currencies or versus commodities. So you have inflation, right? The more dollars you print, the less each one is worth, and more of them takes to buy goods and services. Neither one is the case right. Neither scenario is the case right now. We don't have too many dollars chasing too few opportunities, and we don't have. Excuse me. We don't have a devaluing currency versus our foreign currency counterparts. So neither one is likely to happen, and you're seeing that reflected in the TIPS break-even spread. Looking at where the markets are right now at 219 on the 10-year. Bond market still trades after 4 o'clock, unlike equity markets, right? So you're 219 on the 10-year. You're about 62.5, let's say 63 basis points on the 10-year TIPS, right? Subtract one from the other, and you have an inflation rate, in the 160s. And they are in the 160s. So the bond market is pricing in 1.6% inflation headline for the next 10 years. Now, we all know that that's probably not going to happen on the money. It might print at 1.4, it might print at 2.4. We don't know. But the bond market is telling you there's not a whole lot of inflationary pressures out there. And if people think that because the bond market, the long end of the curve, like the 10-year, didn't rally below 2% this time, that August for a spike in rates, or the fact that on pie in the sky optimism after comments out of China and Japan that it popped into the low 220s, that augurs for a coming pop in interest rates. They don't understand the bond market. They really don't. And this is getting a little irritating for us bond professionals. But we think everybody's going to, all these let's say less knowledgeable people are going to learn the error of their ways. So that brings us back to what we said we discussed tonight, next week's FOMC rate decision. And the other day I wrote in my report that it's about a 50% chance the Fed tightens. After I wrote that, my old partner, Bill Malley, co-founder of the Making Sense report, writes to me and says, if it wasn't for this problem in Europe, the immigrant problem in Europe, and I think we meant also by extension the IMF and now the World Bank saying, hey, the Fed has to, take its time in tightening, that Ms. Yellen might in fact tighten next week, and that the odds would be greater than 50%. I agree with that. I agree the Fed should tighten. I said the Fed should tighten last September. For Pete's sake, we're gonna go to a range of a quarter to a half, probably, when the Fed does tighten. The only assets that should be structurally, and even this would be relatively minor, I think, structurally impaired would be the junkiest of credits, right? Now the pain could move higher because of a psychological effect. Everybody starts selling everything that's considered risky, and then you have a self-fulfilling prophecy. But the Fed shouldn't worry about that, because in fact the Fed should welcome that, because to get the economy going, we have to weed out the dead wood. There are companies, there are projects that probably shouldn't be, and it saps resources and capital, or capital resources from companies and projects that could better use it. So we need that healing process. That's the next step. If the economy is going to hit a next leg, it might be because the Fed tightens. Never mind that we, with the baby boomers still holding most of the wealth, a little bit more income. Not that it'll be much. Can't hurt, right? This economy is more dependent on interest income rather than cheap interest expense from borrowing, at least more so than it was before, right? You don't need to have all this borrowing like we had in the past, because the population is older and they tend to borrow less but save more and spend income. All right, and this is and this is what another thing that's changed in the economy, and the modelists still haven't figured this out, or they're moving to that side of the argument, kicking and screaming. So I still think that there's about a 50% chance the Fed will tighten next week. I think the Fed should tighten next week. I welcome a tightening. If investors are going to be silly enough to sell out of their quality equity and fixed income holdings on that, they get what they deserve, in my opinion. I know most of the viewers here are financial professionals. We have a few investors who watch these broadcasts. So I'm telling both groups of viewers that own what you know what you own. The larger, better capitalized firms are probably not going to become impaired because of anything the Fed is likely to do. Municipalities, the better ones, especially the revenue bond issuers, the water and sewers, the powers, the airport revs, they're going to be pretty much unaffected by what the Fed does. So if there's any weakness in that, it might present a buying opportunity. The problem is not everybody owns actual bonds, and if you own other types of investments, I'll say, where you don't own the actual bonds, then even if you're buy and hold, you're not really buy and hold, because you're subject to the actions of others, which can result in realized losses. You can hold your instrument, but you cannot prevent the securities within that instrument from being sold at the wrong time, especially if there's mass liquidation. So that's something that you have to be careful of. That's why it's better, and if you can afford to own actual bonds and even actual stocks, the ones you want. Yeah, it's not, you don't get the diversification sometimes unless you have a larger pool of money. But you know what? If you own in quality, you own in quality. You're not risking that much, relative to, diversification doesn't necessarily protect you if it exposes you to assets that one, are not appropriate, or two, could underperform. So yeah, I prefer to be tactical and pick and choose. So, and we're seeing some panic in the credit markets, both in corporate bonds and in municipals. Those spreads blew out the past month. Now they've come back in a little bit recently, which is good news, but it presented great buying opportunities out there because now spreads are starting to renormalize, and they're still pretty wide, right? So there's still opportunities even farther out on the curve. We posted we added two curves to our credit curve, taxable muni curves, and they really actually do yield on a risk to reward basis, when you consider the credit quality, better than corporate bond yields. The problem that we ran across through some of our readers and viewers is that they become so style box based that they can't think out of the style box. It's, well, you buy a model, don't you? And you buy a corporate model or a taxable muni model or a tax-free muni model. You don't mix assets. Well, yeah, you do. And especially on the taxable side, what's the difference if I own a taxable muni or a corporate bond, right? It's the same strategies. It's the same exposure as far as taxability goes. It still meets the mandate. And taxable munis right now are yielding at least as much, if not more, than similarly rated corporates. And be considered, the methodology for corporates rating corporates by the rating agencies is much less strict than with municipal bonds. Municipal bonds, basically an A-rated muni has a similar credit risk. As a rule of thumb, it's not guaranteed, but as a general rule of thumb, an A-rated muni has about the same credit risk as a AA corporate. And so if you look at A to A, A-rated to A-rated, and I'm just going to share the screen with you because this is actually an interesting screen. If the computer cooperates here we go, and screen share. Wrong button. I'm challenged here. I'm old. And screen share. I apologize for being clunky, but I'm old and clunky. All right, look at that. We have taxable munis in red, and down here in blue we have A-rated corporates. They're both A-rated. But look at the yield pickup you have 10 years out, and the average yield is 393 for taxable A-rated muni, and it's 352 for the corporate. And when you consider that an A-rated muni tends to have, not guaranteed, but tends to have less credit risk than the corporate, well, the muni is a no-brainer. So if I'm building a taxable portfolio, why would I, for the sake of my own style, for the sake of putting everybody in a prefab model, I'm going to do a disservice to the client and say, well, it's a corporate model. We're just going to keep it here in corporates. When the taxable muni gives me not only a higher yield, but probably less credit risk at the same time. Sorry, guys, I'm not going to be locked into a style box, for the sake of convenience or for the sake of simplicity, for my own sake or the sake of a financial advisor who wants something easy to explain. That's just not going to happen. So there is value out there, but you have to think out of the style box. And by doing that, you don't have to take more credit risk. You can actually do it while taking less credit risk, at least in theory. And probably not anymore in practice, probably less in practice as well. So this is what you need to know. Even if you're using a manager, you need to know what he or she is doing and understand. You don't have to be an expert, but you have to have a working knowledge. Be your own advocate. Like they tell you in the medical field, you don't have to know as much as the physician, right? But you need to have a good working knowledge to make sure that you're getting the right treatment. That holds true in investing, using a portfolio manager, and for clients using a financial advisor. Even you'd have to understand his or her mindset, what they're looking at, and have a basic understanding of the markets, or a basic understanding of the economy, not in depth, but just a working knowledge to be your own advocate. The old Sims clothing chain used to say an educated consumer is our best customer. I like having educated customers on my side, both for portfolio management and my subscribers. It makes my life easier as well. There's fewer suitability problems when we're building a portfolio, and there's less disappointment because everybody is on the same page and know what to expect. So we're back to the yield curve again, and if we can go back up here and look at the U.S. Treasury curve, and I'll share that screen with you in a second. And I touched on it briefly before about what the curve is telling us. There was another silly comment made by a financial professional saying that the yield curve is telling us that if the Fed tightens, it could crimp growth, it could squash growth, snuff out growth, and that's not what the yield curve is telling us at all. The yield curve, which has gotten flatter over the past month, is simply telling us that the Fed is tightening in an environment in which inflation is probably going to remain fairly low. So, and that's what the yield curve always reflects, is inflation expectations, not growth expectations. Again, most of the time, growth and inflation move in the same direction, but not always. When they diverge, the bond market always follows, and at least up to now, 100%. Do the research on your own if you'd like. 100% of the time, it has followed inflation pressures, and that makes sense because the reason you want more yield for locking your money up for a longer period of time is to be compensated for the inability to keep up with inflation because your money's locked away, right? So the time value of money, you want a higher return for locking your money up for a longer period of time, and we could see here. And it's not much. It's not much at all, but it's. I get this screen up here. I am clunky. I'm old. And screen share here. And we'll share this screen here. You can see here, that's the wrong one. I got the wrong one. See, I'm clunky. Let's do another screen share. This the one? That should be the one. And here we are. It's this screen here, and you can see on this screen that the yield curve, that solid line, is starting to move up on the front end, but not on the back. It's still positively sloped. It's not indicating that we're heading towards a recession or a major slowdown, but it's just reflecting that the Fed's probably going to raise rates soon, and that inflation is not going to be a problem to push longer-term rates higher. So we get a flattening of the yield curve. Not a flat yield curve, but a flattening of the yield curve. And that's all it's telling us. It's not telling us that we're going to have slow growth. We're probably going to have growth in the twos. It's telling us we're probably have inflation in the ones, and we're probably not going to get much inflation from wage pressures because workers, and this is the Fed paper, I want to go back to that a bit, it has said that work is probably being commoditized and that there's not enough negotiating power for workers to ask for higher wages. Unions are relatively powerless compared to what they were. Jobs can be done elsewhere or automated, and we're seeing that to an extent in today's JOLTS, job layoffs and turnover data. We had 5.7 million job openings, the most since the records have been kept for the last 15 years, right? Yet, this is for August data, yet in August, we saw barely any wage growth, or no pickup in wage growth, in 2.2, 2.1 and change. That's where we're on wage growth. But with all these job openings and that aren't filled, you would think that there'd be a lot of wage growth. Here's what's happening, and it appears to be happening. These companies would like to have more employees. There are job openings, but they don't need them enough to really increase wages appreciably. And that's the sad fact, because labor is now a commodity, and they have alternatives. They can automate, they can outsource, they can hire a bunch of part-time workers. There are all alternatives. So the paradigm has shifted. The relationship between the unemployment rate, job openings, and wage pressures has broken. And it always breaks. It was different 50 years ago than it was 20 years ago. And it was different 100 years ago than it was 50 years ago. As technology changes, as consumer taste changes, as globalization changes things, this relationship is going to change. And again, this is the danger of pigeonholing your strategy into a rigid model that's based on correlations holding up. Because unlike physics, where correlations will always hold, equal and opposite reactions, Newtonian, right? Well, economics is not that rigid. because it's made up of human beings who have faults and foibles and changing tastes, and technology, which changes not only the amount of labor, but the kind of labor that's needed. That all changes. So these rigid correlations are not something you can you can build a portfolio on and just sit back and forget about and say, all right, I'm set. Because then what happens, you get blindsided by the unks. And we'll mention Bill Malley again. He was a big fan of saying that back during the later stages of the housing bubble and the early stages of financial crisis. It's the unknown unknowns, the unk. There are things that you can't anticipate. You don't and can't anticipate that come back to bite you. And if you don't leave yourself flexible and nimble, you can't adjust to them quickly enough, if at all. That's the danger. You have to be tactical. And that seems to have been lost in the last 5 or 6 years, when no one wants to be tactical. Just put me in a style box, put me in a sleeve, and we'll just buy a little everything so I can avoid all the potholes, or I can hit every one. Tell that to the people who own junk bonds and own EM stocks, or small caps. Well, they would bet all on one side, and the converse is true. If somebody owns utility stocks and treasuries, well, they'll all bet on the other side. They have interest rate risk in both sides of their portfolio. So you have to understand this, and I think that's becoming a lost talent in this business. So next week, I still think the Fed, there's a reasonable shot that it tightens, and I don't think that the markets suffer much, because maybe initially you get that panic, but come on. The U.S. economy is on solid footing, maybe not as great as we're used to on a recovery. We probably won't see junk bonds rally as they usually do in the early stage of a tightening, because the Fed brought all that forward. But it's not likely we're going to a recession. It's not likely we'll see a spike in long-term rates. There might be a little bit of a tantrum, but the market abhors uncertainty. At least the Fed would be giving us some certainty at that point. So that's what I have for this week. But I did want to mention, and I mentioned this when I sent out the email for this, that I'd be broadcasting from a new location. And this is it, a blank wall. Actually, it's not the wall that's important. It's where the wall is, which is important. And where the wall is Wealth Strategies and Management's / Bond Squad's first branch office outside of our home office in Stroudsburg. We now have a new office in Wilkes-Barre, Pennsylvania, right next to the Susquehanna River, high enough to not be flooded in a storm, but right next to the river. We are expanding. We are looking to add more financial advisors. I would like to add more fixed income people to both market the business and to help manage portfolios. We're growing in all areas. So if anybody out there would like to join Wealth Strategies and Management / Bond Squad in a advisory capacity, in a SMA sales capacity, and to a lesser extent in a fixed income strategy capacity, want to jump on board here, please contact me directly. Again, my email is thomas.byrne, BYRNE, at WS, that's Whiskey Sierra, the word and, A-N-D, amazonmike.com. I can be reached during market hours, actually with our new phone system, all hours, but I might not answer you late at night, at 570-424-1555. Don't get rattled on these down days in the market again. The market is simply repricing for a new reality, a more sane reality, not a pie in the sky, trees grow to the sky reality, but a reality where China's maturing and slowing, where Europe and Japan are probably going to bump along dealing with population issues. At least, hey, with the refugees, maybe Europe will get some positive population growth if they can ever integrate foreigners into economies. So far, they have not been able to do that very well, especially France. We'll see what happens. But and we're looking at the U.S. growing probably in the mid-2s on average, given the construct of the U.S. and global economies. And that's where we are, and the markets are simply repricing to that. Please do not think this is 2008. It is nothing like 2008. I lived through 2008. I know what caused 2008. I saw a lot of 2008 coming in 2007 and wrote about it. While at a firm that was one of the causes of 2008, which made life awkward in 2007. But this is nothing like that. The U.S. banks are more than well capitalized. I think with the Fed stress test assumes one of the scenarios assumes Dow 6,000. Good luck with that happening. Probably not happening. Even then, the large banks would not be impaired. So this is not 2008. It is actually 2015, and this is not a recession. This is not a pricking of a bubble. It is simply resetting to a more sustainable economy, more sustainable outlook, and that's it. If people are going to panic, there are opportunities out there. If you're smart enough, if you want ideas, call us, subscribe, hire us to manage portfolios. We do it all over. And that's all we have today. Just a quick note, Friday is September 11th. That is a sensitive day for me and for many of my colleagues and former colleagues, given our closeness in both proximity to the events in Lower Manhattan on September 11th of 2001, and to our closeness to some of the victims out there. So that's a somber day for us. Say a prayer for those who are no longer with us. And I'll be in the office, but it'll probably be a subdued day that day. I'll be working on the weekend in the trenches report. If you need me, I'll be there. But it's another sad day. Comes around once a year. So with that, have a good night. Hang in there. The world's not coming to an end. Far from it. Just only know we own. Buy quality on dips. Sell excessive risk on spikes. You're probably going to be okay. Have a great night. Goodbye.